The reason Wall Street is about to crash the stock market. Force the Fed to pivot. Why recession will come even though we all seen it coming. This is the most expected recession in history. I am hearing that's exactly the reason why it's not going to happen. So let me ask you, everybody expects the sun to rise from the east tomorrow. Does that imply that there's a higher chance that the sun won't rise tomorrow at all? Nope. Why Wall Street is about to crash the stock market. Force the Fed to pivot. Why recession will come even though we all seen it coming. Created by the Fed. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Early last October, Neil Kashkari, the president of the Federal Reserve Bank of Minneapolis, spoke to several dozen graduate students at the University of Minnesota. Federal Reserve officials tend to choose their words with exquisite care. One misstatement or clumsy phrase in shorts and flip-flops can spook the financial markets. With the Fed, the nation's central bank, rapidly raising interest rates to combat the highest inflation that the United States has experienced in 4 decades. Wall Street was especially skittish. Kashkari, who is 49, carried with him a bottle of Cherry Coke Zero. He drinks soda throughout the day and seldom goes anywhere without a bottle in his hand. But the Cherry Coke Zero was also a way into the story that he wanted to share about inflation, which began spiking in the first quarter of 2021 and was running at around 8% year over year. Prices were rising quickly and unpredictably, and merchants stretched for workers because of a very tight labor market. Were having to adjust how they operated in order to keep pace. A sign that inflation was possibly becoming more deeply rooted. That was a punch in the gut at 8 in the morning. Kashkari said, drawing laughter from the students. Zooming out, Kashkari explained that the Fed had initially thought that the rise in inflation would be temporary. But unchecked inflation can be ruinous, and Kashkari said that for the Fed, the question became, how much are we willing to roll the dice? The central bank was now aggressively increasing interest rates to bring inflation back to around 2%. Its long-established target. If the Fed failed to get inflation lower, it would damage its credibility and sow doubts about its ability to guide the economy. We at least need to walk the walk. And we underscored an essential point about the Fed. When the Fed is in the news, and it has been in the headlines a lot lately, the focus is inevitably on the central bank's chair. That was the case under Alan Greenspan, Ben Bernanke, and Janet Yellen. And it's also true under the Fed's current chair, Jerome Powell. The effort to rein in inflation is seen as a test of his leadership and a battle that will go a long way to determining his legacy. Monetary policy, though, is made by a committee that includes the Fed's chair, the 6 other members of its board of governors, and the presidents of the 12 regional banks that are part of the Federal Reserve System. There's a good chance that the Fed could push the economy into a recession. A former Treasury Secretary, Lawrence H. Summers, put it when we spoke recently. It's hard to stop a car on ice without skidding. If there's a recession, the pain will probably be felt most acutely by those on the margins, the very people that Cash Carey was eager to help. In a sense, Cash Carey has come to embody the harsh trade-offs at the heart of the battle against inflation. When Paul Volcker died 3 years ago at age 92, he was widely remembered as the savior of the American economy. The imposingly tall, cigar-chomping Volcker was the Fed's chairman from 1979 to 1987. At the time of his appointment by President Jimmy Carter, the United States was reeling from years of high inflation, high unemployment, and sluggish growth. Stagflation was the word coined to describe this miserable triad. 2 years before Volcker was named Fed chair, Congress passed the Federal Reserve Reform Act, which decreed that the central bank had 2 primary tasks: keeping prices stable and promoting maximum employment, what has come to be known as the Fed's dual mandate. In the late 1970s, the Fed was failing at both. Volcker believed that curbing inflation was the necessary prerequisite for a return to economic health. Inflation is the rate at which prices increase over a given period of time. The biggest sin any central bank can commit is to allow inflation to become entrenched. When it is persistently high, and it was around 12% annually when Volcker took office, it erodes the purchasing power of consumers. Their money is worth less and less. Under Volcker, the Fed raised interest rates to 20% and tipped the economy into recession twice. Once in early 1980 and again the following year. Loosely defined, a recession is when the economy contracts for an extended period. But the draconian measures worked. By 1983, inflation had plummeted to around 4%. Unemployment was coming down and the economy was recovering. In economic and financial circles, Volcker became a sainted figure, credited with laying the foundation for decades of low inflation, relatively stable growth, and rising, if unevenly distributed, prosperity. Interest rate decisions are made by the Federal Open Market Committee, or FOMC, which meets in Washington 8 times a year. It consists of the 7 members of the Fed's Board of Governors, which includes the Fed chair, along with the presidents of the 12 regional Fed banks. The last time the Fed tightened interest rates repeatedly was between 2015 and 2018. During that period, it lifted the Fed funds rate by 2.25 percentage points. In just the last 10 months, it has increased the Fed funds rate by 4.25 percentage points. Not since the early 1980s has the central bank raised interest rates so drastically, naturally inviting comparisons to the Volcker era. there are certainly similarities. Then as now, inflation was a global phenomenon, and it was driven by a combination of government spending and supply shocks. In 2006, Henry Paulson, the chairman and chief executive of Goldman Sachs, was appointed U.S. Treasury Secretary by President George W. Bush. At that time, Cash Carey was an investment banker for Goldman in San Francisco. When Paulson was named Treasury Secretary, Cash Carey left him a phone message expressing a desire to join his team in Washington. After first working on issues involving alternative energy, Cash Carey was asked by Paulson to look at the housing market, which following a long run-up was suddenly tanking. When Lehman fell, Cash Carey recalls it was a break-the-glass moment. The Treasury Department, working with the Federal Reserve, came up with a $700 billion rescue package, and Cash Carey was put in charge of it. The government ended up making a profit on the bailout of the banks, but it was widely unpopular. While millions of Americans lost their homes and savings, the Wall Streeters who crashed the economy were rescued from their own greed and folly, even though he became an object of scorn. Cash Carey says he understands the rage that people felt. The bailout was antithetical to the spirit of capitalism. And, as he puts it, when you violate the core beliefs of a society, I think it leads to great anger. The anger was exacerbated when none of the major culprits faced any legal reckoning. The central bank, in its latest forecast, had projected that the Fed funds rate would increase to at least 5%, and that there would be no rate cuts this year. But the markets were pricing in cuts starting in its second half. I've spent enough time around Wall Street to know that they are culturally, institutionally optimistic, Cash Carey replied. I said it seemed almost as if the markets were playing chicken with the Fed. Cash Carey laughed. They are going to lose the game of chicken, I can tell you that. The history will repeat itself. That's why Wall Street is about to crash the stock market. Force the Fed to pivot. This is my client Teddy Eazzy's book. It is an erotic novel. It's called Wicked Pussy Perfume. Such an amazing book. Order your copy today. And this is my client's book. It's already yours. Adversity Equals Success. It is a collaboration book with such amazing authors in here. So order your copy today. You are such a good boy for watching my video right till the end. Bye.